In this lesson, we'll add the final layer of the core strategy multiple time frame analysis process, which is the higher time frame supply and demand curve. While the curve happens to be the last component of multiple time frame analysis that we'll go over, it is the first thing you'll check as you analyze the charts. We'll go over why and how it fits into the process later. To give you a better understanding of what the curve represents, we can start with a question. Would you say that $4 for the coffee mug in the photo here is expensive or cheap? The answer is, of course, relative. It will most likely depend on where the price for a mug has been in the past. Instinctively, we do this while we're out shopping. Let's say that within a 52-week range, at its lowest, the mug has been $3, and at its highest, $14. Considering this range gives us perspective to determine that the current price of this mug for $4 is actually relatively cheap. This range, as we've discussed, is outlined on the charts by higher time frame supply and demand zones that we refer to as the curve. The curve defines 1. The high time frame range of wholesale to retail price levels, which, as we've discussed in the past, help us understand whether current price is at wholesale, retail, or equilibrium price levels. This will aid us in determining our trade objective of whether to go long or short. Secondly, the curve defines the intermediary time frame boundaries of expected trend reversals. Lastly, it defines the maximum profit potential of low time frame trade opportunities. Let's look at each of these representations. On the chart on the lower left-hand corner, there is a supply zone up top and a demand zone on the bottom. On the low end of the range, what we've identified here are wholesale price levels. The high end of the price range is where we'll find retail price levels. The middle of the price range outlines the equilibrium price levels. Using the same chart, we can see how the curve outlines intermediary time frame boundaries of the expected trend reversals. We can view this range as an end zone, so to speak, which outlines the playing field of price action. These end zones help determine where the market is most likely to turn. Looking at the example chart, we can see where the trend reversed into an uptrend, moving up and away from the high time frame demand zone before reversing into a downtrend at the high time frame supply zone. The most common locations for trend reversals is to begin at or near the high time frame supply and demand zones. Lastly, the curve defines the maximum profit potential for lower time frame trade opportunities, which combines the prior two representations of the curve. When looking to take profits in the markets, we're always looking to buy low and sell high, and not necessarily in that order. However, the point is that we buy at wholesale prices and we sell at retail prices, which is defined by the curve. This is why understanding the curve and properly charting the high time frame zones is so crucial. Now ask yourself, what is going to carry a trade from wholesale prices up to retail prices, or vice versa, from retail prices down to wholesale prices? The answer is the trend. As we learned, our initial profit target will be based upon the nearest opposing zone on the lower time frame. But if we're trading with the trend, we can ride the trend wave for larger profit potential. However, since every trend eventually ends, we always consider a target prior to the expected trend reversal. So where and how do we determine with high probability where the trend ends? We use the higher time frame end zones, which define the curve. This way, the curve defines for us the maximum profit potential. In the previous example, the initial profit potential of the lower time frame demand zone is at the lower time frame supply zone. The maximum profit potential is all the way to the opposing higher time frame supply zone, where we can expect the trend to reverse. Now you have an overview of the curve and the three things the curve defines on a price chart: the higher time frame range of wholesale to retail price levels, the intermediary time frame boundaries of expected trend reversals, and the maximum profit potential of low time frame opportunities. Defining the curve will allow us to see a bigger picture context, which is necessary to assess the probability of our trading opportunities. Before you move on, memorize the following attributes of curve on the high time frame. On the high time frame chart, curve identifies a range of price levels from wholesale to retail. On the intermediary time frame chart, curve creates the boundaries for expected trend reversals. And on the low time frame chart, curve provides for maximum profit potential. Hope to see you in the next video.